Conagra Brands. Okay, it's a name you definitely see in the grocery store. Puts food on millions of tables,
Yeah.
right? Household staples like Slim Jim, Healthy Choice, Banquet.
Big names.
Exactly. But lately, if you've been watching the market, their stock has just been taking a serious beating. I mean, a 13-year low.
13 years.
It really makes you wonder what is going on behind the scenes there, and how are they planning to turn this thing around?
Well, that's precisely what we're diving into today. This deep dive, it's all about Conagra Brands, specifically their recent Q4 results for fiscal 2025.
Okay.
We're going to explore the market's strong and, frankly, pretty negative reaction.
Yep.
And really unpack how they plan to navigate some pretty significant headwinds.
Right.
Our mission here is really to pull out the crucial insights from their earnings reports, the call transcripts, basically distill it so you, our curious listener, can quickly grasp the full picture, the challenges, their strategic responses, without having to sift through all that raw data yourself.
Yeah, we've done the sifting. We've compiled all the relevant announcements, the earnings call details, market analysis, all custom tailored for you to cut through the noise and get right to the core of what truly matters for this massive consumer brand. So let's jump right in. The immediate shockwaves. Conagra Brands just reported its Q4 fiscal 2025 earnings, and, well, unfortunately, they slightly missed expectations, both on earnings per share EPS, as we call it, and on revenue.
Yeah, slight misses, but misses nonetheless.
They posted an EPS of 56 cents against a forecast of 59 cents. And revenue came in at $2.78 billion, just short of the anticipated $2.85 billion.
And the market's response was, well, let's just say it wasn't shy, swift and impactful.
Hmm.
Following that earnings release, Conagra stock immediately dropped 7.75% in pre-market trading, settled around $18.80.
Wow.
And this wasn't just a blip either. It continued a slide that's left the stock down nearly 30% year to date, hitting its lowest level since August 2012. That's the 13-year low you mentioned.
13 years.
Investors are clearly signaling some significant concern there, no doubt about it.
But, amidst all this market volatility, all this negative sentiment, there was one kind of surprising point of consistency that really stood out in the reports.
Oh, what was that?
Their dividend. Conagra's board approved a quarterly dividend payment, 35 cents per share, scheduled for August 28th, 2025.
Ah, the dividend. Right.
And this company actually has a really impressive track record. They've paid consecutive quarterly dividends since January 1976.
76, that's quite a run.
Yeah, that consistency in shareholder return, even when times are tough like this, it's pretty remarkable.
It is. It's definitely something shareholders will be watching closely. Okay, so let's dig a bit deeper into the actual numbers for this fourth quarter of fiscal 2025.
Right.
It wrapped up May 25th.
Right.
Reported net sales dropped 4.3% to $2.8 billion. Now, if you look at organic net sales that strips out things like acquisitions or divestitures, they decreased 3.5%.
Okay, and what drove that organic decrease?
Well, it was driven by two key things. First, a 1.0% negative impact from what they call price mix.
Price mix, meaning lower prices or people buying cheaper stuff.
Exactly. Either they had to lower prices or consumers shifted to buying less expensive product varieties within their lineup. And second, a straight 2.5% decrease in pure sales volume, just fewer items sold.
So less volume and a negative price mix.
Correct. And this overall performance, it really contrasts with previous periods where Conagra had, more consistently met or sometimes even exceeded what the market was forecasting.
That price mix impact, it really tells a story, doesn't it?
Yeah.
And speaking of stories, their gross profit took a significant hit, decreased 12.1% down to $707 million for the quarter.
Ouch. 12%.
Yeah. And critically, their adjusted gross margin, that's basically how much profit they make per sale after the direct costs of making the food, it tumbled by 184 basis points. That's nearly 2 full percentage points.
Down to 25.8%. Yeah, that's a big squeeze on margins.
It is. Now, on the flip side, their SG&A expenses, selling, general, and administrative, that includes advertising and promotion, or A&P, that actually decreased 17.2%.
Okay, so some cost savings there.
Right. A&P specifically was down almost 15% to $62 million. And they said that was primarily due to lower incentive compensation. So maybe bonuses were down.
Makes sense if targets were missed, but yeah, they cut costs, but it seems, not enough to offset those other pressures on profit and margin.
Exactly.
And that weakness, it was pretty broad-based. It wasn't just one area. Nearly all their segments felt it.
Like where?
Well, grocery and snacks saw a 2.1% revenue drop, and its adjusted operating profit was down almost 12%.
Okay.
The refrigerated and frozen unit, a big one for them, sales fell 4.4%. Adjusted operating profits slid over 10%. Even food service sales decreased 4%.
So pretty much down across the board domestically.
Almost. There was, however, kind of a unique bright spot, the international segment.
Oh, really? How did they do?
Well, get this. Despite its reported revenue plummeting nearly 14%, mostly due to foreign exchange rates hitting them hard and some divestitures.
Okay, so reported revenue down a lot.
Right. But its adjusted operating profit actually managed to grow by 22.7% year over year.
Wow. How did they manage that?
They cited higher productivity and lower SG&A within that specific international division, so some good operational control there, it seems.
That international performance is certainly an anomaly, isn't it? In an otherwise pretty challenging report.
Definitely stands out.
And despite the overall headwinds, Conagra did manage to report some very specific gains in certain pockets.
Like what?
In the fourth quarter, they actually gained volume share in categories like frozen desserts, microwave popcorn, and refrigerated whipped topping and pudding.
Huh. Interesting categories. Comfort food, maybe?
It almost feels like it, right? Consumers are still reaching for those specific, maybe indulgent items. Plus, their joint venture, Ardent Mills, showed some positive momentum. Equity earnings were up 31%.
Ardent Mills, right, the milling operation.
Yeah, apparently due to improved commodity revenue,
Wow.
which helped offset some lower volume trends in that broader industry. So a couple of small wins amidst the challenges.
Right. So connecting these numbers now to the bigger picture, CEO Sean Connolly, he attributed the overall softness to what he called a challenging operating environment. No surprise there.
Yeah, that sounds familiar across the sector.
He specifically pointed to higher than expected inflation, those foreign exchange headwinds we mentioned, and ongoing supply constraints still lingering.
Okay.
And while he stated that their, quote, long-term value creation strategy remains unchanged, he didn't really shy away from acknowledging the persistence of elevated inflation and macroeconomic uncertainty. He basically projected it continuing well into fiscal 2026.
So this is just a short-term bump in the road for them.
Doesn't sound like it. He framed it as a persistent, difficult landscape they're operating in.
Given that, it seems inflation is still the elephant in the room. What exactly did Connolly say about its persistence? Is it really here to stay for Conagra, in their view?
He was very clear on that. He said it's, quote, definitely not transitory.
Ah, the T word. So much for transitory.
Exactly. Connolly noted that this fiscal year, 2026, marks the 6th consecutive year of above-average inflation for them. 6th year.
Wow.
And cumulatively, that's resulted in over $2 billion in higher total delivered costs for the company.
$2 billion. That's a staggering number.
It really is. And their CFO, Dave Marburger, he detailed that core inflation for fiscal 2026 is projected at roughly 4%.
Still elevated then.
Yeah. And a significant driver, animal proteins. Think beef, chicken, pork, turkey, eggs. Those are inflating at double-digit rates right now.
Oof.
And that's a big deal for Conagra because those proteins make up about 20% of their total material costs. So this isn't a minor increase. It's a fundamental shift impacting their cost structure pretty heavily.
And adding fuel to that fire are the newly announced U.S. tariffs. How are those expected to hit them?
Yeah, another layer of cost pressure. Conagra anticipates these tariffs will increase their cost of goods sold by approximately 3% annually.
Another 3% just from tariffs. Annually. That sounds substantial. What does this tell us about their sourcing, maybe their long-term strategy? Are they resilient enough, or does this force a pivot?
That is an excellent question, and it's complex. The guidance they gave specifically contemplates, like, a 50% tariff rate on imported tin plate steel and aluminum.
50%.
Yeah. A 30% rate on some limited imports from China, and a 10% reciprocal rate on imports from certain other countries.
Okay.
And these tariffs, they impact really essential items for Conagra. Things like palm oil, avocados, chipotle peppers, stuff that's mainly sourced overseas because there just isn't much U.S. supply.
Right, you can't just easily switch suppliers for some of those things.
Exactly. So it's not just a matter of price. It forces them to potentially rethink where they get foundational ingredients. It could lead to long-term, possibly very costly shifts in their supply chain, or, maybe even force them to reformulate products if domestic alternatives just aren't available or aren't suitable. Big implications.
Yeah, absolutely. And on the supply chain front itself, it sounds like they face disruptions, particularly later in fiscal 25. But you mentioned service levels bounced back in Q4.
They did. The company reported service levels returning to about 98% in Q4, which is pretty good. but they are actively investing now in supply chain resiliency going forward.
How so? Any specific examples?
Yeah, a prime example is their chicken production. They're actually moving some of it temporarily to third-party manufacturers
Okay, outsourcing some chicken. Why?
to allow them to make internal investments in their own facilities, upgrade, modernize, maybe. The expectation is that these investments will become tailwinds, helping them out, probably in fiscal 2027, as they bring that volume back in-house.
Ah, okay. So a temporary move for long-term strength. Makes sense.
Exactly. It's a strategic play.
Now, beyond costs and supply chain stuff, another key challenge, and this impacts pretty much all food companies right now, is how consumer behavior is evolving. What did the CEO, Sean Connolly, say about how people are spending their money?
Yeah, that's crucial. He noted a distinct decline in consumer sentiment during that Q4 period of fiscal 25.
People feeling less optimistic.
Right. Driven by that persistent inflation we talked about, rising interest rates, just general economic uncertainty. And this translated directly into more cautious spending habits.
Like what specifically?
Consumers increasingly focused on value, on affordability, and significantly trading down where possible.
Trading down meaning private label
Mm-hmm.
or just cheaper brands.
Could be both. Switching to store brands, maybe buying smaller pack sizes, opting for less premium options within a brand's portfolio. Essentially, people are watching their budgets much more closely than before, and that directly impacts how they fill up their grocery carts.
That makes perfect sense. So, okay, looking ahead then, what's Conagra's game plan for fiscal 2026? Especially given those shifting consumer habits and the ongoing inflationary pressures? What's their guidance telling us?
Well, their guidance for fiscal 26 is definitely cautious. It reflects all those challenges we've been discussing.
Not surprising, I guess.
They expect organic net sales growth to be somewhere between -1% and +1%, so pretty flat overall.
Flat.
With a projection for a slight decline in the first half of the year, maybe improving a bit in the second half, adjusted operating margin is projected between 11.0% and 11.5%.
And the bottom line, earnings per share.
Adjusted EPS forecast is between $1.70 and $1.85. Now,
Right.
that is notably well below what analysts had been expecting previously.
How far below?
Previous consensus was closer to like $2.19 to $2.45. So this is a pretty significant downgrade in expectations. Signals a tough year ahead.
That really is a stark reevaluation of their outlook. So it seems Conagra's strategic focus now is shifting pretty heavily towards building brands and really prioritizing volume, right? Especially in those high potential frozen and snacks domains they keep talking about.
That's exactly the message. Sean Connolly stated it very explicitly. I think I have the quote here somewhere. Yeah, he said, "We are in the business of building brands, and it's hard to build brands when relentless pricing actions lead to protracted volume declines."
So less focus on just pushing price up.
Seems so. He views this coming year, fiscal 26, as a, quote, transitory year, where they're consciously investing margin, sacrificing some short-term profitability in the service of driving volume growth.
Investing margin for volume.
Right. They believe that healthy volumes are the real key to long-term value creation and brand health.
Okay, transitory year is, well, it's a pretty optimistic take, isn't it? Especially given the persistent inflation and the consumer behavior shifts you just described. What are the biggest risks to that transitory outlook? Could this bet on volume not pay off? It feels like a high-stakes gamble.
It absolutely is a high-stakes gamble. You hit the nail on the head. The biggest risk, I think, is that consumer sentiment just doesn't rebound as quickly as they hope, or maybe competitors don't follow suit. They keep raising prices, and Conagra gets squeezed. If inflation stays stubbornly high, or if consumers continue to aggressively trade down to private labels or even, just eat out less and cook more simple meals, Conagra's investment in volume could just erode their margins without delivering that expected sales rebound.
Leaving them worse off, potentially.
Potentially. It could also mean they miss out on short-term profits that maybe other companies capture by continuing to pass on costs more aggressively. Their success really hinges on consumers responding positively to what they perceive as better value or compelling innovation from Conagra, even while Conagra has to absorb some of those rising costs themselves.
It's a tightrope walk.
Yeah.
And speaking of innovation, you mentioned that Banquet Mega Chicken Fillets example from last year, mimicking fast food, QSR offerings, and achieving sales massively beyond expectations.
Yeah, that was a fascinating anecdote from the call.
That's a surprising win, right? Does that tell us something about how consumers are thinking about value right now? It's almost like they're trying to recreate that drive-through experience, but, cheaper at home.
I think that's precisely it. That success with the banquet mega chicken fillets, it really highlights this interesting trend. Consumers are still looking for indulgent, satisfying experiences, right? They want tasty food, but they're increasingly value conscious.
Getting more for their money.
Exactly. So if
Yeah.
they can get a product at home that delivers a similar quality or, a similar experience to a restaurant or a quick service meal, but for a fraction of the cost, that's a huge win for them in this environment.
Makes sense.
And Conagra is clearly trying to lean into this. They mentioned focusing more on multi-serve packaging in their frozen lines, seeing that as, quote, white space for significantly higher quality and more premium offerings than what might be currently available from competitors. It's all about offering that affordable indulgence.
Interesting strategy. So beyond innovation and this volume push, what about productivity and how are they managing their whole brand portfolio? Are they cutting things loose?
Yeah, on productivity, they're being aggressive. They expect to run at over 5% productivity savings this year. And that includes efforts specifically aimed at mitigating those tariff impacts we discussed.
How are they finding those savings?
Comes from modernization, automation in factories, things like their connected shop floor work initiatives, just trying to be more efficient across the board.
Okay. And the portfolio?
They're definitely continuing to reshape it. They recently completed divestitures of some well-known, maybe older brands like Chef Boyardee, Van de Kamp's, Mrs. Paul's.
Wow, Chef Boyardee, that's a classic.
It is. But the strategic thinking here seems to be to focus more intently on those frozen and snacks categories where they really see the highest growth potential.
Got it. So trim the slower growers, invest in the stars.
Pretty much. Brands like their canned food business, for example, they view those more as cash generators. They'll likely take inflation-justified pricing there to maximize cash flow, which in turn helps fund the investments they want to make in their higher growth frozen and snacks businesses. It's pretty clear differentiation. Where they expect growth versus where they just want to extract value in cash.
That makes their overall strategy very clear.
Yeah.
Okay, so despite this challenging outlook, this pressure, Conagra is also staying committed to financial health. What's the plan on that front, and are there any other initiatives worth noting?
Yeah, financially, they're forecasting paying down a good chunk of debt, about $700 million this fiscal year.
Oh.
About $600 million of that is coming directly from the proceeds of those recent divestitures we just talked about, and another $100 million from discretionary cash flow.
Okay, cleaning up the balance sheet a bit.
Exactly. They're also projecting strong cash flow conversion, around 90%, meaning a high percentage of their earnings are actually turning into spendable cash. And they are increasing capital expenditures, CapEx, up to about $450 million.
Investing that cash back into.
Primarily into supply chain resiliency, like that chicken example, and also into innovation efforts. And one other thing on the consumer-facing side, they plan to phase out artificial colors across their entire frozen lineup by the end of 2025.
Oh, interesting.
And then across their entire U.S. portfolio by the end of 2027. So it's this blend of financial discipline, strategic investment, and also trying to respond to evolving consumer preferences around ingredients.
Right. Keeping an eye on health trends, too.
So what we've truly unpacked here with Conagra is, well, it's a company facing some really significant, persistent headwinds. Inflation, tariffs. It's leading to a tough short-term outlook, definitely reflected in that substantial stock dip.
Yeah, the market spoke loudly.
It did.
Yeah.
Yet their leadership seems to be making very deliberate strategic choices here. They're investing in those key growth categories, frozen and snacks, even if it means sacrificing some immediate margin points.
The volume bet.
Exactly. All in the name of securing what they believe is long-term value and, crucially, brand health. This really puts them in an interesting position, doesn't it? Especially as we watch how other big consumer staples companies, your General Mills, your PepsiCos, how they navigate these very similar challenges.
Will they make similar bets or maybe double down on pricing?
That's the question. We'll have to see how it plays out across the industry.
So this really raises an important question for you, the listener, to think about. In this era where we know consumers are increasingly trading down because of economic pressures, how effectively can major food brands like Conagra really pivot away from maybe years of widespread pricing increases toward this kind of strategic investment in volume and premiumization? And ultimately, what does that mean for their long-term connection with your grocery cart? The fascinating tightrope walk to observe, that's for sure.